Welcome to yet another video where we talk about a very important topic, particularly for those who are young startup founders, for startup founders, those pursuing entrepreneurship as a career path. How do you raise your first check? And in this particular video, we are going to touch upon all the different things that you need to know from a mindset perspective, from awareness perspective of how to make it work for you, how to improve your chances. Again, this is something where supply is much less as compared to demand for capital, and that is where not everyone will raise their first check. But these are things that you need to self reflect, prepare, and things that you need to know. When we were raising our first check, I remember I used to spend so much time going through investor videos in just plain vanilla understanding what is it that they are looking for, what is it that they want. And I just did that for more than a couple of weeks, every night, 2 3 hours, 4 hours, just to understand what is their language, what is it that they are wanting. And talking to n number of founders, all other Shark Tank brands that appeared with us, everyone else, this is what we need to know when you're going to raise capital. And these are all the 10 points that we will talk about. First, are you ready? Are you as a founder ready? So basically the founder, so when you go out to raise capital, that's a start of a very long journey. And particularly who's going to walk that journey, everything can change. The business can evolve, the team can change, everything can change. One thing will not change. That's largely the founder. The founder will not change. So are you ready? Now, what does mean being ready? Being ready means right now the shorter term activity is you prepare yourself for the capital raise. You go and talk to your multiple investors, explain them your business, come back with a feedback, interest from them. All goes well, you raise the capital. That is the short term process. The long term journey that you're going to work on is once the capital comes in into the business. After that, you're going to build a team, you're going to scale your product, you're going to figure out all different legal parts of the business. You will have quarters or months where the business is struggling. In those cases, you will manage cost, cut cost, downsize. Or if it is booming, if it is growing very rapidly, in those sides the work will be growing much faster as compared to your team, and you will be struggling to find the right people. There will be emails that you need to clear, you will not be able to do that in a timely basis. None of them is bad, but it's just how it is. So are you ready as a founder to walk that journey? Or are you, and also someone else will own a part of your business? It's relatively much more easier to own 100% of your business. Why? Because you are accountable to yourself. You will be able to manage yourself much more efficiently. The downside to that is your resources will be limited, and because of that you will only be able to grow the business so much, or maybe you are able to grow it multiple folds based on the industry that you are in. But are you ready for that accountability that will come in? And that does not necessarily mean something negative, but it is just something, because let's say you and I together we own something half and half. You will ask me questions if I am the one operating, and if you are the one operating, I will ask you questions. So that is the very nature of it, and asking questions does not mean negative. But are you ready for all that journey, all that goes up and down, all that emotional journey as well, all the rejections, all the acceptance? The highs are extremely high, the lows are extremely low. All those things, are you ready as a founder? Next, business readiness. Now, assuming that you are ready, you have it all with you, is the business ready to attract capital? Typically, what this means is, what is the stage of the business? Why do you want capital? Because this question typically answers if or not your business is ready. Do you have the basic premise tested, or whether you can do it by yourself, like you are doing it and that is what you've tested, it is working, and that is why you should raise capital to scale it? Or you go to the market, you see that okay, 10 different people are doing it and you are just copying it, but the opportunity is so big that even the 11th person might win. Even then, is the business ready? Do you have, let's say, identified differentiator? Do you have a product or a service that can be scaled? Do you have something which is proprietary to you, that is unique to you, that is differentiated to you? So all these questions, and it is okay if you don't have all of this right at the word go, because you're only looking to raise your first check here. So let's be fair, your business is not expected to be doing really well. It's just your basic things need to be in place. You should have some product feedback, a basic sense of working product. ZebraLearn app, the way it is right now, it was nowhere close to it when we raised our first check. and pretty confident the version that we will have, let's say 5 years from now or 10 years from now, will be very distant from what we have right now. So don't compare someone's year 5 to your year 1. Here you should have something that is working, a premise that makes sense. For example, me, if you're telling me something, it should appeal to me, or it should tell me that, okay, hey, what he's saying is making sense, and there is some proof that, okay, it is working. If I add more money to it, it will scale. If we have something around that, that is typically something that gets invested, that is typically something that attracts capital. So, is your business ready? Is your business at a place by putting in capital, it will be able to grow further? Next, is your business scalable? The scalability of a business comes from multiple aspects, and typically you will have challenges on why a business cannot scale. Typically, it's because of market size. That's the number one reason. Second, if a business is too operational, too customized, even then it faces struggle in terms of scalability. If it needs far too many people to do what it is doing, or extremely people heavy, or extremely let's say operation heavy, in that case also the business typically does not end up scaling very well. So what is the reason for the business to be scalable? What is the scalability, nature of scalability for the business? That is something that's extremely important. Can the business go beyond, or can you find adjacent opportunities? For example, let's say at ZebraLearn we are selling books. Maybe books grows to a certain number and that does not grow. So can we get into school books, or can we get into courses, or can we get into, let's say, partnerships with universities, or can we get into, let's say, some other business that's related to books? So are there adjacent opportunities if market size is an issue? So those things typically are reasons why scalability is something that people question about. Typically first check investors don't might not question so much about scalability, because even if you do basic performance well, they will end up making a good return. Scalability but becomes a scalable or a significant concern going further in the business. So what is the scalability nature? What is the nature for the business to become big? These are three questions from readiness perspective. How ready are you? Can you attract capital and then build a business that will generate returns for those who have invested at the early stage? How do you go about the prep work? The prep work, you need to figure out the valuation, the pitch deck, and the business plan. Now let's address one by one. What is this? Let's do pitch deck. Pitch deck is very simple. In a PDF, you have to explain your business in about 8 to 15 or 20 slides. Very simple. Your problem, your product, how does it fix it? So far, what has been the progress? What is it that you're raising? Where will you reach by this money? Simple. Make it as visual as possible. Why? Because people don't write text. Absolutely don't write text. People don't read presentations or PPTs. People or investors typically swipe through it. So maybe they'll spend 2 minutes on the entire pitch deck. So in that sense, you really have to, it's largely the industry, the opportunity, the differentiation, the success so far that defines how much attention or how much attraction does a pitch deck get. The role of pitch deck is not to raise capital. The role of pitch deck is to get you a meeting. That is it. So don't make a pitch deck which will get you capital. It is not going to happen. Pitch deck is just to share around and get enough number of meetings by getting people interested in what you are doing. That is the role a pitch deck plays. Don't raise capital here. You can't. Get meetings. More meetings that you get, better are your chances of actually raising the capital, and that is the role that pitch deck plays. Everything else comes later, the valuation, the business plan. Here your KPI should be how many meetings is my pitch deck able to get me. If I'm not able to get multiple meetings, I should probably park that pitch deck or probably not use that pitch deck. So this is how you go about pitch deck. Remember, when you are making a pitch deck, make it as visual, use charts, use layouts. Don't write paragraphs. In fact, I'll suggest don't write more than 40 words per or 45 words per slide. Anything more than that, maybe you can have one or two slides that's relatively text heavy, but even then use bullet points. Don't make extremely heavy textual PDF or textual pitch decks. No one will read them and this will just get swiped or this will just get skipped. Have your connect information on the last page, whether be your email, whether be your WhatsApp. Typically best is to have a clickable WhatsApp so that people can directly, you don't know where your pitch deck reaches. Clickable WhatsApp or clickable form, something that's clickable, gets pause or gets a message and gets an interaction right away. So this is how you go about your pitch deck. The next thing that you need to look at is your valuation. Now valuation is something that you can't estimate for a young startup. So when you are going out for a first check, typically it's ballpark numbers, assuming if your industry is very new, what is the industry, what are other players raising at. The idea here is to raise capital, close capital, not to be too particular here, but at the same time not dilute too much as well. So any number, most cases, now again there'll be exceptions of businesses doing very well, very low, but dilution of around 10% typically, this is what you should be expecting. Now this is a very generic thing, by the way, what I'm saying. You might be raising, let's say at a very early stage, actually you might be raising $1 million and you might dilute a fourth of your company or a quarter of your company, or you might be raising maybe 10 lakhs and maybe a 10% number might not be good enough for that, or maybe you have been in business for the last 7 years and then you're raising capital, so maybe your business has grown bigger than that. So valuation typically is ballpark number. Look at other players that are raising capital, what are they raising at? It's not logic. Here you can't put, okay, this is my revenue, this is my multiple. Unless you have a sizable revenue, you can do that, but early revenue, few lakhs, couple of lakhs, 4 5 lakhs revenue multiples and all those don't work. Typically it is something where the investors are comfortable, where they see the next round happening, what you can achieve with this capital confidently in a bear case scenario. Those are things that are much more reliable to come to a conclusion that, hey, what, whether or not I'll be able to make a return. When investors are writing checks or talking about valuation, see, at the core they would want to own as much as possible, or a larger part. Let's say you're offering 10%, they would want 15%, 20%, that can go on. But ultimately they will invest in a at a valuation where they feel that, okay, I will be able to make meaningful return in my next and subsequent rounds if this person is able to deliver what they are telling. If your business is able to deliver what the promise is, let's say for ZebraLearn we say that, okay, we'll be able to get so many books on the platform. If we are able to deliver on that and we are able to meet the numbers that we establish or that we feel that we should be established, only then any investor will put in the capital at today's valuation, assuming that what will the business look like in, let's say, 2 years, 3 years, when the story has panned out the way it is or the way it has been communicated. So evaluation is largely investors' comfort, their ability to make a return on the number that you are asking them. You're asking them for, let's say, you're doing a couple of lakhs in sales or 5 lakhs in sales, you're asking them for 30 crore, 40 crore valuation. You know what's going to happen? You will go from 3 lakhs to maybe 40, 50 lakhs also in monthly sales. But even then, their valuation or their value will go from 30 crores to maybe 45 crores. Hardly any appreciation for so much that they have taken. So that's essentially the balance. That's where the balance is in terms of valuation, in terms of how much do you dilute. It is better to think in terms of how much are you diluting rather than what is the value of the company. Because when you're starting out or when you're raising this and you have not been in business for at least 3 years, there's actually very little value that you can assign to it because you don't know what the business will look like. It can go in all sorts of directions. So this is valuations. Business plan typically looks like an Excel sheet. Business plan typically means you can make it month on month, quarter on quarter, year on year. This is what it looks like. This is my revenue right now. I will do these three things. This is what I will do next year. This is how my P&L will look. When you create a business plan as an early stage business, investors typically are not quite unlikely that exactly those numbers are going to work out. You will have things that you have not thought of come up. You will have things that you had planned not happen. So what is it that typically what they're wanting right now? They are wanting how you are thinking. What is the direction in which you are thinking? What are your assumptions? How valid are those assumptions? How right are you in their head? How right do you sound to them? How logical are you? And overall, what's the nature of the business? These are things that you pretty much end up establishing in the business plan. This is what the investor's expectation is. It's not that, okay, hey, I promised this, this is what will be delivered. It almost never happens this way. At least in my experience, it has not happened. And majority other experiences, it has not happened. Maybe for very, very seasoned entrepreneurs who are able to make extremely predictable business plans as the moment they start the business or in early years of their business, maybe there it pans out, but for majority of us, it's not going to happen. So better it is to establish the direction of the business here rather than the absolute that, okay, this is going to happen, that is going to happen. Next, once you have these things in place, next step is reaching out to investors. Once you have the pitch deck ready and a brief message ready, start reaching out. Now, where do you find investors? I'll tell you my experience. Go to LinkedIn, subscribe to premium subscription. Every single day, message 20 people with the word angel investor. Hey, we are building this. This is our pitch deck. Why don't we connect and can we chat? I did this, and this is how I got about 35, 40 meetings in the first round that we were raising. Works very well. Works extremely well. In fact, our first check actually came via this, a cold reach out. Mr. Rachit Chawla, he's someone extremely dear to me, extremely close to me. We reached out. The connect was via a cold LinkedIn reach out. We just reached out on LinkedIn, and there are so many connections, friends that we made in those rounds that come up in later rounds as well. So it's not necessary that they will participate in the first check, but once they see the business shaping and they will know you for last 1 or 2 years, this is where they will start the discussion. This is when they will start working, hey, this is something that makes sense to me. So maybe further rounds also. So here you are seeding all your connects in this particular space. So reach out people with the word angel investor. Number two, go to tools. There is a tool called IcoMatch. It's a paid tool. So you can use that. That will give you relevant people who are relevant for your industry, relevant for your business. They will come back to you based on your reach outs and so on. Number three, there are so many lists that are going around for early stage capital. Go check that list out. Majority of them will have a website. Go to the website, fill up the form. They will come back. These people are very responsive. Remember, it's not just the founder who wants good investors. Even good investors want good founders. So it's a balance that you're fighting. But at the same time, the challenge is that there are X number of investors, but 200X number of founders. So that is the imbalance that you're fighting as well. At the same time, just plain vanilla cold reach out every single day. Don't do it one day for 100 people and then don't do it at all. Consistently do it every single day for 20-25 people. It's going to probably take half an hour to 1 hour of your time. It's that simple to get these calls. Number two, reach out to people in your connects who are relevant or who you think are interested in that space. Friends, family become a very important part. People who know your ex-employers, your teachers. There are multiple entrepreneurship cells. So does your college have an entrepreneurship cell? Reach out to them. This is how you reach out the first set of investments. I don't believe, or I will not suggest you a lot of go to this event, go to that event. That's a lot of waste of time, and also more than waste of time, it's also one of the low ROI activities for time and money involved. You will also be spending significant amount of money here. So just a plain vanilla digital reach out, cold email. This is something that works most time efficient and cost efficient. Do this. Number six. This is the hard part. Handling rejection. Because imagine you will be reaching out to 20 odd people a day. What is going to happen? It's plain math. 20 people a day, 15 people will not even see you. Before we do this math, let's address one thing. How many people do you need to write your first check? Maybe one, two, four, five, not more than that. You need maybe 4 or 5 people to trust you to write you that check. That's it. So your goal is four. Your goal is not 400, not 4,000. What is it that you're going to do? You're going to reach out to 20 people every day for a month. You're going to reach out to 600 people. What is it that's going to happen? You will typically get only 10% of people to come back to you. So let's say you are reaching out to 20 people a day. You're only reaching out effectively, or you will only get 2 to 3 messages revert every single day. So basically, you're only getting, let's say, 100 reverts. Now, out of those 100 reverts, in our experience, it was 50-50. 50% people said we are not interested. 50% people said, okay, let's get on a call. So out of 100, 550 people gone. But now you're getting 50 meetings. 50 meetings, that's what you're going to get. And you need to convert maybe 4 people out of them. That is one. You also go to multiple different companies, angel partners, venture partners, incubation centers, accelerators, all sorts of people. You are going to get rejected by majority of them. Out of 50 you need 4 people, so you're again going to get 46 rejections if it works out. If it doesn't work out, you're probably going to get 50 out of 50 rejections. So this is the hard part, this handling rejection. You are going to get rejected. It's part of design, not because you are bad, but because someone is not interested in your business, not the space. Someone did not like who you are as a person, your vibe. So be it. You also might not like someone. So be it. You don't want everyone's and anyone's capital. If they didn't like you, please don't get capital from them. Third, let's say they did not like the space that you're interested in, or they don't have free cash right now, because angel investors work out of, a lot of them work out of business cash as well. So maybe the business seasonal, and for 3-4 months their business occupies majority of their cash. So you don't know, your timing is off. So for n number of reasons, they will reject, they will not accept. In fact, from our first set of investors, we met them and then they rejected us, and then again after 1 year, that is when they wrote our first check. These are the different journeys that you walk through. So hard part is handling rejection, but here one realization is really helpful. Think of your business as third person. Don't make your business as I, me, myself. ZebraLearn can have, let's say, a bad quarter. That does not make Anurag a bad entrepreneur, or that doesn't make me a bad person. This realization came to us, let's say, as late as 3 years, 4 years into the business. That businesses will go up and down does not make you bad person. 2 years back, ZebraLearn was doing exceptionally well. Then it was doing for 2, 3 few months, it was not doing that good. And then it was doing again very good. So what did that mean? That I became a very good person, became a very bad person, and then became a very good person? No, not at all. I was a good person throughout, is what I feel. So that is exactly my message here for you as well. Business is a third person. Your business, you can change your business if it doesn't work out. A lot of times you're trying, it doesn't work out. So business is third person. It's not your self-worth, it's not your self-identity, it's nothing to do with you. It's your skill set, your opinion. It's you get the benefit of it if you get it right. But it's third person. For example, if I make the whole video that we are making right now, I make this whole video very poor. Does it make me a bad person, or does it make me a bad content creator? Maybe I learn and improve. But right now, at this point I'm not ready. That's the worst that can happen. So that is what it means. Your business is a third person. This helps you handle rejections, because you will get rejections left, right, and center. And this is where the demotivating part is. I will also tell you, this is when no one says no outright. They will say no and they'll give you 4 or 5 reasons. This is probably the best feedback that you will get, because this is coming from mature people who have seen a lot of other businesses as well, and they've spent half an hour, 45 minutes in on your business, and then given you a feedback. Put together the feedback that we got in the first maybe 6 odd months of pitching or to raise capital. That feedback has been very crucial to shape ZebraLearn and the journey that we have been on. So this is exactly something that you need to prepare yourself for. Also, next thing is your time availability. How much time do you have? Because this is a full-time role, or if not a full-time role, this is going to take a very long period of your time, of a lot of your day, so much so at least half your day, and also a lot of brain space. Why? Because this is the next bottleneck in your head. So you're consistently thinking, I need capital in the business. So anyone and everyone who's interested, you are answering them on priority. You are thinking about them. Okay, what is it? What more can I tell them? What more can I tell them? This is what it means by time availability. Do you have the right amount of time available? And I will link point 7 with this. This is a mistake that we made. This is one of the biggest mistakes that I have made in my journey. We stopped building the business and started focusing only on capital raise. This is the worst thing that you can do, because you're now all of a sudden all your eggs has gone in someone else's basket or in someone else's control. So put them in one basket, which is capital raise, and given it to third people. You need to take control back. Where is your control? This is your control. Building the business. When you build the business, let's say even if you're not able to raise capital in 6 months, your business would have still made progress. Maybe you became investable in somewhere in that 6 months, and then you raised your first capital. Otherwise, what happened? You are stuck at one place. You are sitting there. You are talking to a large number of investors. Your business is not moving. So your current state is something that you're fixed for, and maybe you're fixed on it for 6 months. So you need to make progress at the same time. Maybe you share your work between founders, co-founders. One is responsible for capital, one for growth. But don't stop building. Never, never, never stop building. This is where you lose a lot. Even if, let's say, investors are rejecting you left, right, and center, you believe in it. You keep building. You want to make a pivot. You still keep building. That is the essence of it. You need the time availability, but at the same time, you need to keep on building. Next, valuations. Valuations, I think we have discussed over here. The math here, something that's important is the investor math. Listen, here's how the investor is going to make money. When they are putting in capital in the early stage, they know nothing about your business. Trust me, they know very little about your business, and also they have very little control over it. It's largely you that they are putting capital on. It's largely that, okay, hey, this is one, you are someone that they can trust. Trust is extremely important, otherwise no opportunity will ever come to you. Number two, you are someone whose interests are aligned, meaning you are not doing 5 different things. You're doing this one thing, and you will continue doing this for next 5, 8 years. These are two things that is a must from an investor perspective. If you can't get them confident on these two things, you're not going to go very far on with them. Number three, at this place, they are investing in you. What is happening? They are investing at a very small valuation. They're going to invest at maybe 4 crores of business value, 5 crores, 10 crores, typically sub 10 crores, majority of them in India. Maybe as if your business is little more mature, then maybe a larger number, but single or double digit crores valuation, majority of them. What is it that they're looking for here? They're just looking for business performance. Business performs even a bit. You go from 5 lakhs of monthly sale to maybe 40-50 lakhs of monthly sale in next 1 or 2 years, they would have typically made some sense of return. So their money has appreciated. Now the next thing is they will sell their shares depending on their appetite. Different people have different appetite. For example, InfoHedge held their first investments till date in Zomato. It's been about 15 odd years. People sell their investment. Contrary, they sell it as soon as they get an option as well. Now, next investor, when they come on board, this is not a good time for the first investor to sell. This is not a good place also where a lot of exit options will be there. But the third round that the company is raising, at this time, the investor will look to exit because they would have made significant money. They would have maybe grown their money 5x, 8x, 10x, something around that. And it's only going to happen for them in maybe 1 of 10 investments that they make or 1 in 5 investments that they make. So it's also going to happen for them in relatively limited number of investments that they are making. So this is their math. This is their math, plain vanilla. And out of this, they might have 1 or 2 companies which they are invested in for 10 years and grows beyond imagination. Something like a Zomato or Ola happens to them. That is something where they make disproportionate amount of return, disproportionate amount of wealth, if they are able to keep that for a very long period of time. But on a day-to-day terms, their math is very simple. They are looking to, let's say, go from X to 10x. And to do that, one, the business needs to perform. Number two, there should be second market, there should be some follow-up market activity around people getting an exit. So this is how you raise your first check. Knowing all this is something that's extremely important to raise your first check, to raise your first capital, to get your first money in the business. Also, last thing that I forgot to mention, check out all the government schemes. This is beyond imagination, things that can happen there. There are multiple schemes. I'm not completely aware of all of them, but there are multiple schemes that you can look at. Just you need to, in fact, go on icomatch.com. They have a section called grants as well. You can look at it there as well. Also, plain vanilla chat GPT will give you a lot of these answers on what are different government schemes. That is yet another. Sometimes it's also grants. The government does not necessarily take equity. So all of these can help you get started with your first set of capital, can get you on your path. But at the same time, don't stop building. This is something I can tell you as possible. Don't stop building. Your first check will come when it has to. Maybe 2 months, maybe 6 months, maybe 2 years. You don't know. But your business needs to keep on growing every quarter, every month. And trust me, there are always ways, unless you are building something that requires a capex or anything of those lines. There are always ways where you can find growth without capital as well in most cases. So this is how I will tell you to raise your first check to build your business. Do shoot out in the comment section any and every question that you have. I hope this has been helpful. Do give us feedback as well, what all can be improved. I will keep on creating such videos going forward in extreme amount of detail. This is something I enjoy extremely, and more than enjoy, I love the feedback that we get.